All right, welcome back to China Stock Market. This is a weekly wrap. I am your host, Jack Kuzi, filming here from our studios in Milsons Point, Sydney, Australia, where we wrap up every week what is happening in China's financial markets, particularly its stock markets, allowing you to make a better informed decision. Still a little bit under the weather, been like that for the last couple of weeks, but we're going to push through. It's 7:02 a.m. here in Sydney. It's Friday, the 19th of April. We're going to wrap up the week preceding this Friday. And as always, it's been a busy week. It's been a volatile week for global markets in general. A lot of choppiness out of the world's market leader in the United States. Certainly tech stocks coming off, certainly semiconductor stocks coming off. But China has bucked that trend this week, outperforming. We're going to get into the market performance. We've seen some policy support from China during this week. We're going to cover it all. Thanks for tuning in. If it's your first time listening to us on podcast, then leave us a 5-star review if you can. Share it with your friends. Downloads are going up very, very slowly, but they're going up. If you're listening to us on YouTube, please leave a comment, give us a like, hit the subscribe button. Trying to push this out. I don't think there's any content like this anywhere where we just cover stocks. There's a lot of geopolitical content, a lot of economic content, but nothing like we do here. So the more support we get, the better, I guess it'll be, the more motivation I'll have. But I'm certainly motivated. I love covering China's markets. So I'll be here regardless. Let's get stuck into the disclaimer. The video, the podcast, the contents, the information that I give you is for information purposes only. It does not constitute a recommendation to purchase or sell securities either in Chinese equities or anywhere around the world. It's not intended to be financial advice. No representations, no warranties. And just remember, guys, I try to keep it as up-to-date and factual as possible, but sometimes I can't, and these opinions are my own. All right, we're going to change it up a little bit this week. We're going to do market performance, and then we're going to do quick hits, but I've extended the quick hits. And just touch a lot more points that are happening in China. So if you've listened to us previously, kind of did 3-4 quick hits. But this week, I think I've got 12 or even more quick hits. And I'll just emphasize those a little bit more. And then I'll do like a deep dive into some areas. I'm going to talk about the Chinese banks off the back of some policy support. We're going to look at some of these dividends that Chinese banks are paying, which are very, 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 very attractive. And let's talk about a 9-point plan issued by, which organization or association was it? It was the regulator, the securities regulator, issued a 9-point plan to make financial markets in China the world leader. We had a data dump. So GDP, retail sales, industrial figures come out of China. And then I'm also going to talk about Alibaba off the back of a deep dive report by Caixin Global around the sale of LME, around their shift in the e-commerce business, and really talk about their e-commerce business. So I did a video on the back of that on TikTok and talk about that going forward. So that's how we're going to run it. Let's get started. Let's have a look at the market performance. So as you can see, for the SSC composite, and if you're listening to us on podcast, you can't see this. SSC composite was up 2.01% for the week. Now remember, we go from Friday to Thursday. So Friday last week, which is the 12th of April, to Thursday the 18th of April, and then I filmed this on Friday the 19th of April. Why didn't you film it on a Saturday, Jack? I've got kids, I've got family. I like to do it on a Friday morning. Shenzhen composite up 1.54%. Hang Seng down 2.79%. So a bit more choppy, but the mainland certainly outperformed this week. So a positive news for mainland, down for the Hang Seng index overall. If we look at the monthly performance, all in a negative, and I think that's off the back of negative leads coming out of the United States. And then the performance for 3 months is 8, 6, and 6. So 8 and change for the SSC, 6.29 for the Shenzhen, and 6.37 for Hang Seng. So again, some bad leads from the US off the back of some hot inflation data, and maybe some of that froth coming up from what has been an incredible rally from the United States over the last 6 months, maybe a little bit more. All right, let's get started with quick hits, and we do have a few this week for you. Okay, let's take a look at quick hits. And if you're listening to me on YouTube and watching, you'll notice that I had a shirt change. Didn't like the way the blue was looking. I think it needs to go to the dry cleaner. So I'm in a white shirt. So don't be alarmed. All right, let's get into quick hits. We're going to run through a few more quick hits this week. I just think it's a better way of wrapping up all the things that are occurring on a day-to-day basis in China's financial markets, which is so deep, so wide, so many companies, so many industries. I mean, fair enough. This is the second largest economy in the world, largest exporting nation in the world, largest manufacturing nation in the world, certainly probably the second most influential country in the world. I think it's the most important country in the world in terms of the global economy. But let's get through it. All right, so we saw Apple supplier Sunny Optical, and this was on Monday, fall 3.53%. And that's off the back of, and this is in Hong Kong, and that's off the back of Apple reporting that iPhone shipments were down 10% year over year globally in the first quarter. Apple supplier Sunny Optical was a key component into the cameras within an iPhone. So softer sales for Apple there. Certainly Apple's had a lot more competition on the mainland now, particularly with the Huawei Mate 60, which has been a massive seller. So if memory serves me correctly, that sold 1.5 million units in its first month when it got released. I think it was the second biggest selling phone in China for the first quarter of 2024, behind Vivo actually. So a lot more intense competition. Mainland listed CRRC, which is a railway stock, gained 11% on positive profit guidance. So along with other major railway and railway equipment manufacturers, and this is off the back of a bond issuance that we saw in China last year for infrastructure. So they raised some money to build in terms of infrastructure. Railway was a big part of that. And it kind of appears that the stimulus from that is now coming through, which goes to investing in China. You've got to really look for telltale signs from the government, right? It really comes from, it's a centrally commanded economy, and therefore you can really get some good investment insight when you look at what the central committee is doing or what the government is doing. The China Association of Automobile Manufacturers announced that, the electric vehicle had a strong week on fresh data off the back of CAM, which is the China Association of Automobile Manufacturers, showing that March new energy vehicles were up 35% year over year. Some mixed news around EVs, really, within China. If you remember a couple of weeks ago, we talked about a kind of survey that surveyed owners of electric vehicles and whether they'd buy a new one. And those rates of uptake were down quite a bit. And I think that's off the back of a lack of charging stations or a lack of charging sufficiently, or what's the word I'm looking for? Efficiently is the word I'm looking for within China. And then we get figures like this. You've also seen some mixed reports from the EV makers. Some really good sales, some really good growth year on year numbers, but then some flagging in terms of uptake. And you're also in the midst of a massive price war within China, which may be settling down somewhat as we go along. Baidu announced that its Ernie AI-powered chatbot has crossed the 200 million user mark. Talked about Ernie bot, Ernie, I'll just call it Ernie. I don't know why I keep calling it Ernie bot. We talked about Ernie last week, actually, on the back of reported deal with Apple to use Ernie as their AI component of new iPhones, on the back of a deal that is in place for the Samsung Galaxies that are being built and sold in China. Didn't really move the share price. The share price was down off the back of it. But it goes to that AI large language model race within China, the race to become the ChatGPT of China. You've got to think Baidu's in the box position. We'll remember that from their earnings report, they sold, they are selling Ernie at the moment. So I'm sure that the Ernie sold component is part of that crossover into 200 million. I think it was 61 million US dollars in revenue they were getting from that. Not much, but still something. So that was an interesting point, or an interesting announcement that came out of Baidu, often the forgotten stock of China's tech. We did cover them, particularly their movement into cloud and their growth, and using AI to grow their cloud division and using AI to grow their advertising division on the back of Baidu Search. German Chancellor Olaf Scholz is in Beijing off the back of Janet Yellen being in Beijing. And he was there to talk about, I think he was there to pressure China. Well, not pressure, but ask China if they can pressure Russia to end the war in the Ukraine and come to the negotiating table. China obviously has a big part to play there, having some economic ties with Russia. They also talked about manufacturing and exporting. I think I cover this again in a quick hit, so I won't talk about it. If I don't, I'll come back to it, particularly around EVs. China also released a draft proposal to further tighten its emission caps. Now, if they implemented it, this would be the first major upgrade of its climate policy in many years. Got to remember, there's a lot of talk around Chinese overcapacity around solar panels. And, you know, China is a world leader in reducing emissions. One, I think, because, you know, they had a lot of emissions there. You know, there's often those signs or pictures of Beijing being under smog, particularly before the Olympics, and how they clean that up. But two, because they recognize this is a major industry globally. You talk about lithium batteries, EVs, solar panels, etc., and overcapacity. But this is the kind of first major upgrade in policy we've seen in many years. So it'll be interesting to read that policy and see if there are any telltale signs about where we should be putting our hard-earned dollars into Chinese stocks. Let's keep going here in terms of quick hits as my keyboard goes asleep for some reason. I don't know, my keyboard keeps falling asleep, but anyway, that's not for you to deal with. All right, let's look at online retail sales figures. So, interesting component here. Online retail sales figures increased 12.4% compared to only 3.1% overall. So, retail sales figures overall, going to the shops and trading online or buying online, increased 3.1%. Online retail sales figures, so people purchasing online through e-commerce giants like JD, Pinduoduo, Alibaba's Tmall, Tmall, Taobao, etc. Well, it's got to be Tmall because Tmall and Taobao, because Tmall is consumer to consumer and Taobao is business to consumer. Were up really well, which goes to the increasing penetration in China. And I think this is a result of policy. You will remember that the Chinese tech regulation that we had a couple of years ago, where they fined Alibaba and there was mayhem, part of that was to remove walled gardens. So let's, for example, Tencent had a big chunk of JD. You couldn't use Alipay to buy things on JD. Or you couldn't use WePay to buy things on Alipay. Closed off those walled gardens. Or you couldn't send a link on WeChat for a Alibaba e-commerce or Tmall e-commerce link. Removed that, opened up the market. They also removed choosing one of two sides. So if you are advertising on Tmall, you can't advertise on JD.com in some areas. Then they also moved, it wasn't, I'm going to call it price gouging, but it was, price manipulation. And that was like, the data is telling us you really want this product, therefore we're going to increase the price. Perfect example I use is traveling. So let's say you're going from Beijing to Ningbo, and there are two different people looking for those tickets. And for some reason, the algorithm is working out that you need to go to Beijing, you need to go to Ningbo from Beijing, and you need to go on this certain day. It kind of jacks up the price. So they really went through and tried to eliminate these kind of things. And I think we're starting to see, one, innovation. So they've kind of allowed players not have two or three major players like you've got in the United States. And two, it's kind of a fairer market. And the consumer is coming back. There's an element towards that. So, but very interesting figures, particularly when we look at market rebounds within China and whether that's going to be led by the consumer. And figures like these are pretty good. All right, so the CRC, which is China's Securities Commission, released some or clarified some potential impacts on new delisting rules. So we've seen a lot of policy rhetoric or a lot of policy, going to implement by the Chinese regulator. One of them is around delisting rules, and particularly around zombie firms. So zombie firms with rubbish balance sheets really shouldn't be listed, unprofitable, listing on markets. And small caps got hammered on the back of that news because people are worried about that they're going to come in and clean up the market, and that a lot of small caps listed on mainland exchanges and in Hong Kong, not directly Hong Kong because of this, and in Hong Kong will be delisted. And then some of those better small caps I think did well on the back of, we're solid companies and we should be listed. So, the regulator is really trying to clean up this market. We've seen a lot of this type of support or a lot of this policy initiation. There's policy initiation around day trading and market manipulation and shorting on the close. So I think there are good signs around China. Credit ratings agency Fitch said its outlook for a handful of large Chinese banks has changed for the better. This is in contrast to Fitch saying that China's government outlook or their debt wasn't as great, where they moved them from stable to negative. This week they came out and said Chinese banks are in good hands, and we're going to cover Chinese banks a little bit, particularly their dividend yields going forward. All right, so BYD introduced its first electric supercar called the Super 9 under its new premium brand, and I'm going to botch this pronunciation, Fangchengbo, not too bad, featuring bold design elements and a space shuttle-inspired cabin and carbon fiber. And I've taken this from TechNode, which is a great website if you're looking for Chinese news and Chinese market news, particularly around tech. Things got racing seats and is, part of their brand's upscale shift in the EV market. So the car was designed by ex-Audi chief Wolfgang Egger, and it's a sign that Chinese EVs are just really stepping up. There's no class, no market, subsector market within cars which they're not penetrating. I had a look at it. It looks pretty good. I mean, I'm not a car person. And this is off the back of another supercar I think they have. Oh, this is their first electric supercar, but they did do like a high-end car to kind of rival the Ferrari, emphasizing higher motion and speeds. Detailed specs and pricing remain undisclosed. The unveiling precedes BYD's presentation of more high-end models, including hybrid and all-electric vehicles at the Beijing Motor Show. So BYD continues to really innovate and push. Of course, they are the largest EV car producer in the world, overtaking Tesla at the end of last year. Xiaomi ranks third in Q1 global smartphone shipments. We talked about Xiaomi and the EV. We talked about Xiaomi and the Internet of Things and connecting all those around. Xiaomi, when we talked about it, I think it was the third biggest supplier of smartphones in the world. And for Q1, it kept that ranking. Trivia question, who is number one? Or who was the top 5 smartphone brands in the quarter? I'm going to give you 5 seconds to think about it. Number 1. That was Samsung at 20.8%. Second was Apple. This is global, not just in China. Apple at 17.3%. Xiaomi at 14.1%. Transsion at 9.9%. Oppo at 8.7%. Xiaomi shipped 40.8 million units and marks a 33% year-on-year increase. While Oppo saw a decrease in shipments to 25.2 million, down 8.5. Oppo is not listed, if I remember correctly. And that first quarter increase was 7.8%. So, I'll talk about iPhone market or smartphone market softening, particularly for Apple. Certainly hasn't softened for the Chinese suppliers. And I think you're just seeing an upgrade, particularly within China. Let's talk about Meituan, one of my favorite Chinese tech stocks, actually. They announced that they're pushing further into restructuring its core food delivery unit. You got to remember they're actually starting to expand food delivery globally. And I know it's not much of an expansion, but they're moving into Hong Kong now. And I anticipate you're going to start to see Meituan in other parts of the world. And food delivery is a massive component of the globe now. If you think about, I liken it to e-commerce. We transitioned away from buying things in the store to buying things online, and eventually 100% will be bought online. That's just a fact. Maybe not 100, maybe 99. Look, even when you get to a retail store, when you want to buy a washing machine, you kind of decided online before you go in there and buy it. I think food delivery is going to be an increasing component of global megacities. And what I mean by this is we're just going to cook less. I know my family cooks less. We go out a lot more and eat, but food, because I just don't like things being delivered in a box on the back of a guy's motorbike. I don't know. It's just something about it for me. The only thing I can actually get delivered is pizza. Everything else I don't like it. I just can't deliver myself a burger, but I'm sure this will get better. And I'm sure I'll come around to it. But I think, Meituan, food delivery is going to be a global phenomenon. And when you look at these massive industries that come out, e-commerce, ride sharing, which I really love. I love ride sharing as a business. I was a big fan of Uber years ago. You get multiple players in the industry. And then because it takes so much money, so much data, so much resources to become competitive and profitable, you wind it down to 2 or 3 players. I think this will happen with food delivery, and it's already happening around the world. So, you've got your Uber Eats, your Meituan, and then there's Food Panda. I mean, here in Australia, we've got, who's the US one? Jeez, I can't. DoorDash, right? We've got DoorDash, Uber Eats, and we've got a Menulog, which I think is a European brand, rebranded out here. But you kind of succinct that down. Meituan will be a global food delivery company around the world. No doubt about it, because 1, they've won the war in probably the most competitive market in the world. 2, their data in getting around China makes them even more efficient when they get into other cities. And I think this is a phenomenal company considering the other areas of the business that they have. Anyway, back to the news point. They've announced younger people into management level. It's the company's latest round of changes this year as it looks to adapt to increasing competition. However, they are the market leader. The Chinese food delivery giant has eliminated the direct business division as part of the adjustment, bringing in a city-focused model to support operation developments based on specific city characteristics. Love that. Meituan has established a separate department to better serve nationwide chain stores. So they do grocery deliveries and starting to set up some of those offline chain stores. The company recorded a 25% year-on-year rise in annual revenue to 276.7 billion renminbi last year, with its average daily takeout order volume amounting to 55 million in 2023, which is significantly short of CEO Wang's goal of 100 million units per day by 2025. I think there are some things that didn't allow that, but I love this company. And, I'm an owner of that, so just to let you know, and this is not a direct recommendation. Then we had just yesterday, we had a proposal from Biden, or President Joe Biden, around tariffs on steel. Steel names were relatively unaffected after that. And some analysts are saying that this is because the US remains a relatively small market for Chinese steel producers. I think this is more of a, going into what is this year going to be an election year. And then lastly, JD.com last night announced that the company repurchased 1.2 billion worth of shares in its first quarter, representing nearly 3% of its shares outstanding. The company also initiated a new share purchase program, which will last until 2027 and involve repurchasing nearly $3 billion worth of stock. Stock fell 7.1% in Hong Kong overnight. And this is just, we've talked about this a number of times. There are so many Chinese companies, Chinese tech companies, Chinese manufacturing, across all industries which have buybacks. In fact, they're at record highs, along with kind of policy support to, or policy rhetoric to increase dividends. It's just another support mechanism for these companies which have been beaten down over the last 4 to 5 years. That was Quick Hits. I actually enjoyed doing that. I think we covered a lot more, and I think I'll do that going forward every week. But I would love to hear some feedback from you if you like that better. For those few of you who are listening, we do run some YouTube ads, which increases the numbers artificially, trying to get more people watching. But I know there's a small group that watch me every week. If you could let me know in the chat, or I don't think you can leave comments on podcasts, but maybe in the 5-star review. That'd be great. Let me know. All right, let's move on. All right, let's take a look at the financials within China. We saw a massive pop on the banks, which actually progressed as the week gone along. And that's off the back of China's sovereign wealth fund activity. So we covered this 4 or 5 weeks ago. We talked about the national team within China who's been buying Chinese stocks and ETFs. Well, they come out and announced that since October, the fund had invested 5.23 billion yuan, 722 million, in the Bank of China, Agricultural Bank of China, Industrial and Commercial Bank of China, otherwise known as SCBC, and China Construction Bank. These are the top 4 largest state-owned enterprise banks in the world. Some of the largest banks in terms of Tier 1 capital on the balance sheet. So that took China's sovereign wealth activity. So they acquired 330 million shares in Bank of China, increasing their stake to 64%. China Construction Bank purchased 71.4 million shares, raising the stake to 57.14%. Agriculture Bank, they bought 401 million shares, resulting in a 40% ownership. And ICBC, or Industrial and Commercial Bank of China, 287 million shares since October, and now hold 34.79. The strategic intent by the fund is that the fund had committed to continuing bolstering its positions in these banks over the following 6 months, supporting their long-term development. If you don't know who Central Huijin is, they were established in 2003, and they focus on investments in state-owned financial institutions. Their sovereign wealth fund is worth around 1.24 trillion US dollars. And they've also been purchasing exchange-traded funds since October, which is in conjunction with other government measures that have helped recover the A-share market from its lowest point in February. So what does this mean? Well, there's a couple of things. These banks which are listed are pretty much government-owned, which, you might think is a negative, and I get that sometimes. But I had a look at these share prices kind of in line with what's happening in October, and you can see a real correlation. When you look at the bank's balance sheet, look, I'm not an accountant or a CPA or a CA, but I'm in markets long enough to have a look at balance sheets. They're actually very well capitalized. In Chinese banks, and I know they're going under a massive property, bubble at the moment, but a lot of the issues that could possibly be shown up are in those second and third tier lenders in China, not these top 4 banks, which have massive cash deposits from Chinese citizens who are the largest savers in the world. And they have lent to this property market, but they have fairly good balance sheets, fairly good assets protecting themselves, and they're protected by the government and owned majority by the sovereign wealth fund. Then I took a look at their dividends, and I own the Bank of China through its Hong Kong listing, and really I own it for a dividend, and I bought it actually a couple of years ago because it yields at the moment, when I picked it up, it was about, in the high twos, which is roughly about an 8.5% dividend. But its dividend yield is 7.89%, right? Now, its next payment date is the 5th of August, and the ex-dividend date is the 8th of July 2024. The Agricultural Bank of China, that is a dividend yield of 7.37%. Its next payment date is the 28th of June, and its ex-dividend date is the 30th May 2024. China Construction Bank has a 9.05% dividend yield. Next payment date 2nd of August, ex-dividend date 4th of July. And ICBC, or Industrial and Commercial Bank of China, 8.28%, ex-dividend date 8th of July. And the next payment date is the 19th of August. Really good dividends on. And you don't just invest for dividends, but some people do. And I thought I would highlight the yields and the bank yields that China's banking, particularly their top 4 banks, their state-owned enterprise banks, are offering. And if you look back on their dividend payments, they haven't missed a dividend payment, I don't think ever. I'm not going to say ever, but for a long, long time. So they have historical notion, and I think China really wants to press that, we pay dividends, we pay them on time, and we pay them all the time to attract foreign investment and to, shore up domestic investment. But these are very, very attractive yields. 4 companies that have rallied really well in the last 6 months, but in the preceding 2 years have been on the decline. So I thought that would highlight that. I really like the yields of some of these banks, and I could find them a little bit more in my portfolio going forward. Let me know your thoughts in the comments section on these bank yields. I would love to hear from you. All right, let's move on to the 9-point plan. So this was a state council's 9-point guideline for the development of China's capital markets. This was a fairly big piece of news. I'll tell you why. Because this is only the 3rd time they've ever released something like this by the state council around China's capital markets. And the first time they did it was in 2004, second time was in 2014, and then our 3rd time. So every 10 years, it looks like they're going to do something this. But the long-term goals are to establish clear goals for capital markets for the next 5 years and through to 2035, and to make China a high-quality capital market that matches those of global financial powerhouses by the middle of the century. And that was official from the State Council's 9-point plan. So make China a high-quality capital market that matches those of global financial powerhouses by the middle of the century. Will not be the same as global financial powerhouses. And this is the point I'm trying to make here. And I did this on Money FM radio. I was about to make this point, and then I got cut off because my phone cut off. However, if you are investing in Chinese markets, do not play the same playbook as investing in New York markets. They're not going to be the same. They're still going to be state-run. There's still going to be command central economy. You're going to have to deal with different types of guidelines and different types of variables that you deal with in modern markets around the world. So they won't be the same, but what they are trying to be is a powerhouse globally. They want the greatest companies in the world. They want them listed on their own exchanges, and they want to attract foreign capital, but they will do it their way. So let's have a look at it. They want to strengthen regulation. So they want to enhance regulations on the listing process. And they've done that. So you've seen a real halt on IPOs coming out of China. And I think they're trying to clean up some of the rubbish that they had listing in previous years. We talked about the zombie companies that they're looking to delist. We're talking about, enhancing regulation, enhancing market integrity. And that comes on their 3rd point. So there were 9 points. Long-term goals: 1, strengthening regulations; 3, supervision enhancement. So increasing supervision of listed firms, how they report, how they give market news to maintain market integrity. Delisting regulations. We covered this. Delisting zombie firms or unqualified firms to maintain a high standard within the market. Investment attraction. Number 5. Guide more medium and long-term funds into the capital market, right? So more IPOs of good companies raising capital. And I've often said Chinese companies don't need to list in the US anymore because they don't need US capital. And I think the Chinese government's telling them to list in China. Because there's enough capital in Asia for them. Just got to have a good exchange, good regulation, good goals, right? Good supervision. Market adaptability. Number 6, aims to develop a highly adaptable, competitive, and inclusive capital markets along their terms is the precursor or the footnote there. Global financial aspirations we covered, number 7. Institutional mechanism and supervision was number 8. Tackle challenges in institutional mechanisms and supervision that have been exposed by recent market fluctuations. I think that's high frequency trading, selling on the close, snowball derivatives, CBBC warrants in Hong Kong. I think that's the term. Investor protection, market stability. Focus on investor protection. That was number 9. And improving the quality of listed companies to reduce risks and promote long-term market stability. Like it. I really like it. And I don't know exactly what happened after 14 and 04, but I can tell you that, they've got a clear history of implementing some of these. The thing about China is they could introduce massive policy changes, and then they do short, sharp 100 changes to them as they go along. And that's where you get that increased volatility. But you talk about this, you talk about the national team, you talk about Xi's offensive, you talk about Premier League going out, you talk about the meeting with CEOs from the US. I mean, they are, say what you want about the Chinese, they are actually trying, definitely, because I think they need to, and they're very fearful, trying to stabilize their financial markets, trying to bring back the Chinese investor and essentially trying to bring back foreign investment back into China. Will it succeed? I think it will, because it's a market big enough and there's attractive investments within China and they've got a lot of pull and clout. But these are certainly good things along the way. Let's see how they go. All right. Okay, let's talk about a data dump. So we had a massive data dump out of China during the week. GDP growth, industrial output, fixed asset investments, retail sales, exports. We also saw a policy stance in terms of the medium-term lending rate and, kind of overall economic outlook. So let's cover that. GDP growth increased by 5.3% in the first quarter, exceeding the forecast of 4.6%. And I think that's off the back of policy support. We saw a reduction in that medium-term lending rate. That might be having an effect. We've certainly seen some bond issuance. We've certainly seen some fiscal support. Maybe the property market's starting to stabilize, even though we did see some property figures that weren't so great. But that was above expectations. And remember, China's got a GDP growth target for the year of around 5%. So they're certainly in line with that. That was positive. Market didn't take it really well. And I think they weren't taking it really well because they feel like policy support's going to kind of run out, was going to dry out in terms of dry powder. But we'll see what happens going forward. Industrial output, that rose 6.1% year on year in the first quarter, but industrial producer prices fell by 2.7%. Remember, we saw an inflation read last week, which only increased by 0.1%. We were expecting 0.4%. So, they're worried about the inflation. The world is worried about the inflation in China and having like 2 decades of no growth and deflation like Japan had. So that was, even though industrial production rose, the industrial producer prices was a bit disappointing. Fixed asset investment, I think this is definitely on the back of policy support, increased by 4.5%, with manufacturing investment up 9.9%, but property investment down 9.5%. Look, I don't think the Chinese mind the property investment that much. Remember, Xi is famously quoted as saying property is for living in and not speculating, and trees can only grow so high. Retail sales figures grew by 4.7%, a slowdown from the 5.5% in the January-February period. And the reason why the reason why I think the market, go back to GDP increase, was the market was disappointed is kind of there's no more lagging effects of the lockdown anymore in China. You can't say, well, it's off the back of, these are why they're disappointing figures. These are like kind of clean figures of the opening. And that's what I think led to a little bit of disappointment around these figures going forward. They expected them to be a bit more higher, or wanted them to be a bit more higher. The property sector continued to underperform, with residential real estate investment down 10.5%, new housing starts falling 27.8%, and housing completion decreasing by 20.7%. Not great. We do see some good signs out of guys like China Vanke in the last couple of weeks. Exports decreased in dollar terms, but volume expanded, helping China gain more global market share, and that is because the dollar has just rallied, and that's affected those figures in terms of renminbi or Chinese yuan. China's policy stance, they held the key medium-term lending rate at 2.5%, which means they didn't feel like they need to move it, which means they have some room to move if they wanted to. And remember, inflation is not a problem in China. And they talked about outlook. Challenges include the weak property market, and the market wants more policy support, but I don't think they're going to get it, or bazooka policy support, which they've been wanting out of China. So some mixed figures, but I think the GDP growth figure was a shining light there out of China. Not horrible. It's not horrible. It's not fantastic. It's not horrible. But I don't think China wants fantastic. I think they want a gradual increase in growth. They want to promote consistent and more long-term consumer demand. And China doesn't want to grow at 8 or 9% anymore. It's trying to overcome that middle income trap. It's really looking inward. It's really looking to promote consumption within and not necessarily outside, particularly in a world where wars are going up very aggressively. And they're decoupling. All right, so the last piece I'm going to go through here today is a kind of a deep dive on Alibaba. And this is off the back of a Caixin Global report around its restructuring of its e-commerce division, and potential sales or rumors of the sales of its LME. So let's cover the first piece of news there. So this is off the back of, again, a Caixin Global article. I encourage you to read it. There's been rumors that they're going to sell LME since early 2024 as they start to focus or go more inward. Remember, famously, Alibaba split was a proposal to split their company into 6 different divisions and maybe IPO them separately. And there has been talk about them selling assets like Freshippo and Artima and really concentrate on their online business rather than some of this offline business that they got into previously. There is a rumor that ByteDance, which obviously owns TikTok and Douyin, was a potential buyer for LME. Discussions occurred earlier in the year, but did not lead to a deal. This is, again, according to Caixin Global, mainly because ByteDance was not interested in LME's food delivery sector. It was only interested in LME and not its grocery delivery service, because it was kind of a package deal. Alibaba aimed for LME to compete with Meituan, but was caught off guard by the rapid rise of Douyin in e-commerce and then kind of refocused back on that. The market analysts suggest LME is below value and could advantage a competitor. So they've had a lot of struggles with LME. Historically, if you don't know, they acquired LME in 2018 for $9.5 billion US, and that was part of their global expansion or their expansion into logistics and physical stores. But it hasn't done really well for them. If you sub out LME out of their balance sheet, as part of that local services group, which is part of their 6 divisions, they reported a net loss of 2.1 billion yuan in the fourth quarter of 2023. China's food delivery is a massive market. We already talked about earlier in quick hits of Meituan. So, Alibaba going under a real restructure here, I think, at the moment. And part of that is they want to get rid of their offline assets. Now, whether they're able to get rid of LME or not, I don't know, but they definitely want to get rid of those grocery stores, and they really want to concentrate back on their online, which made them the company that they were. And they've certainly, and they've certainly lost a bit of their nous in e-commerce. So they are still the largest e-commerce provider within China. And that's through 4 major brands. So they've got Tmall, which is consumer to consumer, kind of like eBay. Taobao, business to consumer, kind of like Amazon. Then they've got their Alibaba international expansion. So that's Lazada, what's the other one? Alibaba Express, etc. through Southeast Asia, now Africa and the Middle East. And they have 1688, which is kind of like a wholesaler. And then they've got this little website, which I bet I'm going to forget the name. I will, which was mainly aimed at cheap products. So they're really refocusing their domestic strategy, and particularly through through Tmall, they're kind of incentivizing or bringing up cheaper products, offering them first when you search for things on the site to buy. And that is in response to growing market share, particularly by Pinduoduo, and secondly by Douyin, around what is a consumer savvy and more price sensitive Chinese consumer, considering all the economic challenges that have happened. So they've lost some market share and a little bit there now, some of their revenue there. They've also had some economic challenges. You've got a slowing Chinese economy. They haven't innovated as much as they have previously and have lost, again, a lot of market share to Pinduoduo and Douyin, who have been quite innovative in the way they've sold their products and their shopping experiences and challenged Alibaba's traditional model. And they've been under a lot of scrutiny. They've been hit with everything from the kitchen sink. So you've kind of seen a refocus around innovation around their e-commerce platform and pushing some of the low price products when you go on and search for something on the e-commerce platform. The other big move that they're making is they're really, really doubling down on international expansion. They've seen what Pinduoduo has done with Temu in the US. They've seen what Shein has done with Shein in the US. And they're really focusing on expanding globally. And there are some key markets. They already do a good part of business within the US through Alibaba Express, but I think you're going to see a refocus on that. But they're also pushing aggressively into Eastern Europe, Southeast Asia, particularly through brands such as Daraz and Lazada. They've got a massive, strong foothold in Southeast Asia. They're starting to tailor those platforms to suit those markets. They've got a guaranteed 5-day delivery to some parts of the world, including Germany, some parts of Eastern Europe, anywhere. And they've also got some next day deliveries to try to enhance their exposure in those markets. And then they've kind of followed the lead of Pinduoduo, who famously advertised during the Super Bowl. They are now the major sponsor of UEFA Euro 2024. So they're going to boost its visibility and its reputation globally. This is, global growth for them has been like 40%, 38%, around those figures for the last 4 quarters. So it's a massive part. It's around 10% of their balance sheet now. And if they can really, really move into those markets, I think you're going to see a lot of uplift in the valuations of Alibaba if they can replicate particularly what Pinduoduo has done in the US. Now, we don't know what Pinduoduo has actually done in the US because they don't strip out Temu in their balance sheet. And I think they don't strip it out because they're worried about eventually being banned. But I think global growth could be a real massive expansion, particularly for their e-commerce business, which is a massive, or the biggest part of their business. I don't know if it's bigger than cloud, but it's either that or cloud. And when you compare it with its share buyback and its valuations and its multiple compared to its US peers and some of its Chinese peers, it does look to be of some kind of value there. So one to watch there. They also talked about their e-commerce division, their cloud division, I think, which we'll cover in another episode. But some real focus inward by Alibaba and some real focus on their 2 major divisions, and that is e-commerce and cloud going forward. I think the company's making some right steps, and I would love to see how this international expansion, if you continue to see those numbers, I think Alibaba is a buy down here, but this is not a recommendation. All right, that's it from us for the week. I hope you enjoyed the show. If you did, please let us know in any way you can, either by leaving a 5-star review or leaving a comment or subscribing to the channel. Thank you, and as always, good luck with your investing.